makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London with the conversations that matter. Here's what's coming up on today's programme. Nvidia smashes forecasts, beating already high expectations as the AI chip boom shows no signs of letting up. We'll bring you the pre-market move in just a moment. AI optimism has already turbocharged a global rally with Euro Stock 600 hitting an historic high. In Japan, the Nikkei 225 finally tops its 1989 record. Plus, Mercedes shares gain despite warning of lower returns and cooling demand for electric vehicles. We'll bring you more from our interview with the car maker's chief executive. Well, those are your headlines this morning. Let's get you up to date on the markets at the start of the European cash trade. We are firmly risk on as the AI frenzy continues off the back of Nvidia's earnings last night. Goldman says it's the most important stock in the world, and you can see it, European equities are on fire this morning. The Stock 600 off to the races at a record high. It's higher 0.7%. And if you look across that map there, it is green across Europe. The CAC higher 0.8%, the DAX up 1.2%, the FTSE 250 up 0.4%, the FTSE MIB in Italy nearly up 1% this morning. Surprise, surprise, break it down by sector, and it's tech leading the gains, higher 3.2% this morning. ASML shares really getting a boost from those Nvidia earnings, up 4.3%, but food, beverage and tobacco is bottom of the basket, lower 0.9%. Nestle, of course, delivering that gloomy forecast, and those shares are currently lower, 4.3%. Just breaking across the terminal, we have the latest Eurozone PMIs for February. We already had the French services and manufacturing numbers beating expectations. That lifted European yields in the euro. But then we got the reality check from the German PMIs. More mixed, worse than expected. That meant yield pared a bit of the increase. So here we have, for the wider Eurozone, on manufacturing, 47 was the estimate. The actual number, 46.1. So a miss there, but a beat on services. 48.8 was the estimate. 50 is where we come in. The composite number, though, is what you're waiting for. 48.9. A beat on the estimate of 48.4. So these are the numbers for February, very much front of mind for the ECB in terms of deciding when it's going to cut rates. And you've got yields higher across the curve, across Europe, off the back of these numbers. And the euro is higher, 0.4% at 108. We look ahead to the UK PMIs at 9:30, but let's get back to the stock of the moment. It is Nvidia. It smashed forecasts for the current quarter, adding fresh momentum to a rally that's already made it the world's most valuable chip maker. Speaking on the earnings call, the CEO, Jensen Huang, says generative AI has hit a tipping point. It's higher 12% in pre-market. You can see it there. And you've already had the impact on the Asia session. That's set to continue in the US. You've got stock futures stateside pointing to a higher opening, especially on the Nasdaq. That's higher 1.8% currently. So traders really looking past the caution that we got in the Fed minutes yesterday. To explain the significance of Nvidia's earnings and why it's doing so well, I'm pleased to say I'm joined by Alex Webb now. Alex, the market really was poised to sell here, but we've had another blowout quarter from Nvidia. Why do investors keep underestimating it?
I think part of the challenge is that Nvidia does not give full-year guidance. It will only steer one quarter ahead. And, of course, expectations are incredibly high. For the quarter we've just seen the numbers for, Nvidia was guiding for revenue of 20 billion plus or minus 2%. The market was pricing right at the top of that. 20.4 billion was the consensus. In the end, they sort of blew that out the water and reported 22 billion. The fact that they're kind of getting the numbers so wrong themselves perhaps explains why they're not giving that full-year guidance. Nonetheless, we did get a little bit of steer from Jensen Huang, the CEO, on this. He said that 2024, 2025, they still see demand likely to be, continuing with the similar strength that it has right now. That's one of the reasons we're seeing a great deal of optimism coming out the numbers. Yeah,
hit a tipping point has demand, says the CEO. But what are the risks to this growth continuing in the future for anyone who's thinking about getting in on Nvidia but is perhaps a bit worried?
Well, to be very clear, I'm not going to give any investment advice, but the challenge we have right now is that all the demand, or a lot of the demand, is coming from what are known as the hyperscalers, the big cloud computing operators in descending order, you know, the likes of Amazon, Microsoft, and Google with their respective clouds. They are building in the expectation there's going to be a lot of demand for their for their AI products. AI is essentially a cloud product right now. We haven't yet seen those numbers come through in a big way. It's a little bit around the fringes. Microsoft reported a slight boost to earnings per share, or to revenue from demand for AI. They aren't yet gangbuster numbers. That's a slight risk, that it's not directly Nvidia's customers, it's the customers of Nvidia's customers, and whether they come through in the way that everybody's expecting.
OK, Bloomberg's Alex Webb, thank you for that analysis. Lovely to see you. But Nvidia, so it remains the AI darling stock, but how much of a problem is it for investors that a smaller and smaller number of companies are driving gains, not just in the US, but in Asia too? As I say, the Nikkei closed at a record high this morning. It last touched that level in 1989. For more, I'm joined by Maya Bhandari, Global Head of Multi-Asset at BNP Paribas Asset Management. Great to have you on, Maya. Let's start with this question of concentration risk. How urgent is the need to diversify?
Concentration risk is pretty intense, and I think that's the case in both price returns, but also, quite importantly, in earnings. So, you know, Nvidia itself, which we've been talking about this morning, has driven a quarter of the returns in the S&P 500 already this year. But when we look under the bonnet, what's really interesting for me as an asset allocator is actually we've had outside the Mag 7, outside some of those stellar stocks, a pretty soggy earnings season. So if we look at the US, for example, if you strip out the Magnificent Seven stocks, you've actually had a fall in earnings. So earnings, equities overall, as a result, look pretty expensive. So I guess that's just to put a bit more context on it. Now, there are markets, some of which you mentioned in your piece earlier, that do look quite interesting. So Japan is an example where I think you have the fundamental support. You've got some of the companies that will directly benefit from the same sort of stuff that Nvidia is benefiting from, but also trade at really attractive valuations. You know, you've still got a nice discount to global equities. You know, on price to book terms, it's approaching 50%. Price one-year forward earnings, PE basis, we're at 15%. So what we are doing is seeking to get exposure to markets where we can have some exposure to that theme, but without those very lofty valuations that are, of course, a challenge for us.
I just want to pivot to the macro, because, of course, we did have those PMIs out of the Eurozone this morning. But even if Nvidia's arguably the macro now, let's focus on those PMIs. Where do they leave your view for ECB rate cuts this year?
So, I mean, I think on the PMIs, as you reflected, they've been quite a mixed bag so far. So weakness in Germany, strength in other areas. Look, broadly, we're pretty cautious on the European macro outlook this year. And if you look actually at rates markets, while rates markets more broadly have priced out quite a lot of the easing that they were expecting, say, in the middle of January. So in the US, we're about half that easing. Europe's been much more reluctant to price out that easing, and that makes sense to us, because we see Europe in a more challenging place. Manufacturing is a bigger part of the overall economy, and let's not forget, you know, unlike the US, unlike Japan, unlike Taiwan, for example, you don't have those big tech names in the European indices. So it is a different play when it comes to investing as well.
True, yeah. We did also get those Fed minutes yesterday. Jay Powell and co. in no rush to cut rates anytime soon. We had Larry Summers, the US Treasury Secretary, former US Treasury Secretary, on Bloomberg, actually warning that there's a meaningful chance the next move's a hike. What sort of percentage do you put on that?
Well, I mean, I wouldn't go as far as Larry Summers and suggest that the next move is a hike. But I would say that the Fed minutes, but even before the Fed minutes, some of the recent data, the inflation numbers, some of the weaker numbers we had on the retail side from the NFIB survey, I think there is, you know, there are several challenges, if you will, to the immaculate Goldilocks scenario that I think some people are expecting. And I think the Fed minutes, for me, underscored that. We continue to like duration from an asset allocation perspective. Every risk has attached to it a price. But we are half as long duration as we were at the end of last year. So we've taken profits on about half of it. And where are we positioned? Well, we quite like the long end of the US real rates curve. Again, that gives you a bit of protection for inflation. We quite like European investment grade credit, EM local bonds. And I guess the one area where we do expect tighter policy to come through, and would be in Larry Summers' camp, is in Japan, where we are short of rates because we see a different setup there.
And your team's particularly dovish on the Bank of England. Is there any way that the BOE cuts before the Fed, just given how weak the growth picture is here?
Well, I think our central research team are certainly more dovish than the markets. I think they see the case for rate cuts to be much clearer in the UK. Let's not forget, the UK has had a particularly nasty mix of growth and inflation, and the downside risks to our minds are greater in the UK from a macro perspective, and indeed in Europe, than they are elsewhere.
Yeah, stagnation nation, as our Marcus Ashworth put it, for the UK. China, let's just bring in as well, because it's been a theme of the earnings this week, especially from the miners and the banks. Yeah. What's your outlook there? Has the real estate crisis bottomed?
Well, it's a really interesting question, because actually just yesterday we have dipped our toes into the Chinese equity markets in very small size, and I think that really for us at BNP Paribas Asset Management, you know, the valuation case for China is clear. What has been less clear is that the policy that is needed to unlock that valuation will be forthcoming, and I think we've seen much more news, if you will, on the ground, and indeed policy being delivered that to our minds suggests that there is a bottom in place, at least on a tactical basis. So to be clear, I think while I'd say we're more constructive on the likes of Japan on a sort of 12-month view on China, it's much shorter term, really trying to combine very depressed valuations with that policy stimulus that's now coming through. China is just to some people priced as uninvestable, and that doesn't really make sense to us.
As ever, we await the bazooka. Maya Bhandari, Global Head of Multi-Asset at BNP Asset Management. We thank you. Well, we have got Nvidia driving sentiment across the markets this morning. The stock 600 at a record high. But let's just recap some of the other earnings that we've had this morning. Out of London, we've had Lloyds Banking Group. Profit slightly beating expectations, but net interest margins dropping slightly. They've set aside £450 million for costs. This is linked to a review of UK car finance, but they're still pledging a £2 billion buyback, and those shares in Lloyds currently lower 1.7%. We've also this morning had Rolls-Royce, the maker of aero engines, of course not cars, beating both on profit and sales last year. They're also seeing strong momentum into 2024. Remember, this is a stock that rose a staggering 222% last year, and we have Rolls-Royce higher 7.8% this morning. We've also had Anglo-American taking a bit of a hit from the depressed diamond market. Those shares currently higher 2.6%. And WPP as well, flagging a tough year. It's been a well-flagged tough year, really, for the advertising giant in 2023. But it doesn't see much improvement this year either. And those shares taking a knock, lower 2.7%. On the continent, on the food front, Danone out of Paris, the sales rising in line with forecasts as it grew volumes, raised profitability. Danone shares higher 0.4%. And sticking with food, we have Nestlé. Real disappointment here this morning, lower 4.1%. Forecasting a slowdown in revenue as inflation eases, and central banks, of course, look to pivot this year, as we were discussing. Out of Germany, we had Mercedes, and we're going to discuss that next. It's rising after announcing a €3 billion share buyback, but there is a warning on cooling demand for electric vehicles. We'll take you to our interview with the CEO next. This is Bloomberg. Well, Mercedes shares are 4.4% higher this morning after the company announced a €3 billion share buyback. The German luxury car maker expects returns to decline this year as it contends with a slowing economy and cooling demand for electric vehicles. Their CEO spoke to Bloomberg earlier.
We're now adding 3 billion to that, but we're also putting in a general policy as a philosophy that on the free cash flow, after dividend and minor M&A activities, that we want to signal to our investor that that money is available for future buybacks. So if we keep on producing cash flows like we have over the last few years, there is more potential, absolutely.
Mercedes CEO Ola Källenius there after they announced a €3 billion buyback. Well, for analysis, let's bring in Bloomberg's Craig Trudell. Craig, you've got the shares up this morning, 4.4% currently, but lots of gloomy numbers. What's to be positive about under the hood if you put the buyback aside?
Yeah, I think in terms of reasons to be positive, the cash generation is absolutely, what the company is putting emphasis on. The fact that, this is still a company that is running quite well, that, generated a whole heck of a lot of cash last year, that, just a year ago announced a €4 billion buyback. And so this is, a continuation of a theme. And I think the sort of go forward emphasis on the amount of returns to shareholders that they, are sort of, presenting this as the way forward for them, I think is potentially what is the reason why we're seeing the shares react the way they are. Yeah,
are we seeing the end of this pent-up demand for autos? Is that part of the reason for the rest of the gloom in the numbers?
Yeah, I think the fact that, I would say that sales are not by any means sort of falling through the floor. I think it's a question of, the supply-demand imbalance that we saw for a few years that really sort of artificially inflated returns for these companies. We're going to see more balance going forward where these companies aren't going to have as much trouble with production. They're able to meet demand, and demand is holding up relatively well. I think the question is going to be, just how much price pressure we continue to see for this industry. And Mercedes has cut against that in that they've really emphasized the higher end. I think they're willing to maybe give up some volume if it means, continuing to keep margins up. But, if you're sort of looking for, issues in these numbers, it's the fact that, return on sales is expected to slip a little bit. And even last year, you could look at the 12.6% number that they achieved. It was a bit on the lower end of the forecast range that they were looking for. So clearly some pressure in terms of how much they can keep up the level of pricing that they've managed the last couple of years.
Yeah, so that's on the demand side. They've paired their EV outlook as well. But on the supply side, they do mention the supply chain disruptions as a particular risk factor. You've got all the disruption in the Middle East. How much are we likely to see that sort of disruption weighing on margins for autos in the coming year?
I think that, for me is one of the surprises in these results, the fact that the company did sort of sound such a bearish message in terms of supply chain, because what we've seen for the last year plus has been real substantial recovery in the supply chains. These car companies, have not had to worry about, say, semiconductors. But of course, we are seeing, issues in the Red Sea. Thus far, we haven't seen major disruptions on the part of companies aside from Tesla and Volvo, but whether or not that's just a matter of these companies kind of managing through it initially, but only able to do so for so long, I think is something that we may, get a better grasp on in the coming months.
OK. Well, they're not worried about it at the moment. Mercedes shares higher 4.3%. Craig Trudell, thanks for the context. We've actually got autos and parts, the second biggest gainer on the stock 600. That sector higher nearly 2% this morning. Well, coming up, slowing sales growth at the world's biggest food company. We'll dig into those earnings from Nestlé next. This is Bloomberg. This is The Pulse. I'm Lizzie Burden in London, and you are risk on in markets this morning after those Nvidia results yesterday. In pre-market, the shares are higher 13% already, and the stock 600 has hit a record high. But let's dig into some of the other earnings that we've had out of Europe this morning. Nestlé shares down after reporting a forecast of slower sales growth this year. And to break down those numbers, I'm joined by Carla Canivet. Well, Carla, when you say Nestlé, I think sugar.
I think we all think sugar.
How badly are these results hit by the likes of ESG and the weight loss drugs, stopping us eating all the chocolate?
Well, I think Nestlé isn't having a very sugary day. Let's start by saying that the shares were down 5% before I left. I think they haven't gone any further than that. And I think you're absolutely right. One of the things that we have been looking at this year is how the fact that we're more concerned about what we're putting into our system, what we're eating, how is that affecting the food companies? And if you look at how popular weight loss drugs, say Ozempic, have been in the last few quarters and the last few years, really, that kind of tells you a little bit about where consumers are going, namely how Nestlé and other food companies, say Unilever, say a lot of our very known brands, they have to start thinking about their product mix, how they are going to lure customers to buying their stuff.
All right, Carla Canivet, really appreciate that context on Nestlé. The share's down 4.2% currently. Coming up on our weekly Bloomberg UK show, we'll talk fiscal policy with Dan Hansen.